Hi everyone, thanks for tuning into my channel, All Things Accounting. Today what we're going to be examining is simple interest. So stay right there and we'll go through this together. Simple interest, what is that? Well, in order to explore that a little further, we need to define a particular concept, something called time value of money. So what we mean by time value of money is that people tend to prefer payment at the present time rather than the future time because of the interest factor. So when people or organizations lend out money to other people or organizations, for example, a bank lending money out to other people for the purpose of a mortgage, say, that's never done for free. So in exchange for the time that is given to repay the bank, what the bank wants in return is what is called interest. So what we're going to be calculating today is something called simple interest. Simple interest is basically interest earned on a principal amount Now, here, interest can be calculated based upon the following equation. I is equal to P times R, or in this case you could say I times T. Now, here I is the amount of interest, P is the principal, I is the interest rate as a percent, and T is the time in years. So interest is equal to principal multiplied by interest rate as a percent multiplied by T, time in years. So let's say, for example, that if ABC company has signed a 2-year notes payable, okay? Remember that notes payable is a current liability for $3,000, and this notes payable carries an interest rate. It carries an interest rate of 10%. So the interest and principal are paid upon the due date or the maturity of this notes payable, which is going to be 2 years. So if we were to calculate that, in this case, I is equal to P, which is the $3,000, multiply I, in this case is 0.1, 10%, multiply by, in this case, T would be 2 years, and that would yield $3,600. So upon maturity, at the end of 2 years, the ABC company would be giving back $3,000 principal plus about $600 in interest, calculated based upon simple interest. Let's take the same example here, where the principal was $3,000, interest was 10%, and time is not necessarily 2 years. But let's say that it started on April 1st. So that's something we're going to have to call proration. We have to prorate it based upon the impartial or non-full year. So in this case, year 1 would be equal to $3,000 multiplied by 0.10 multiplied by 9 months out of the 12 months of the year. And that would give us $225. Year 2 would give us $3,000 multiplied by 0.10 multiplied by 12 over 12 and that would give us $300. That would give us, yes, $300. Therefore, the total in this case would be $525 of interest. Upon maturity, what the company is going to have to pay back is the $3,000 plus the $525, which yields $3,525. So just notice from the prior example where it's $3,600, there's $75 that is not going to be accounted for because this was a partial year, 9 months out of the 12 months, because it started on April. So this is just a quick example of simple interest. It's not too difficult to compute. I hope you found this tutorial to be useful. Please subscribe to this channel, click that like button, and hit the bell notification icon so that you're always up to date on the new tutorials that I'll be posting. Until next time, take care.